Welcome to my YouTube channel, where we develop fascinating trading indicators and strategies to compete with the market. We have developed a new strategy with several core elements to eliminate failures and FOMO. We have induced several key components to make it successful. Martin's strategy determines the method of analyzing the market and identifies potential trading opportunities for trading intraday on any asset available on TradingView. Martin's strategy defines the criteria for entering and exiting a trade with strict guidelines and rules, making it successful. Clear entries and exit strategies help traders stay disciplined and avoid impulsive decisions. We have implemented proper risk management in the Martin strategy, as establishing risk-reward ratios and position sizing techniques helps manage the risk effectively. We have also implemented trade monitoring and evaluation to keep records of the trades in Google Sheets, which will be shown in a separate video on how to maintain a journal, as evaluating past trades can provide insights into strengths and weaknesses, allowing for continuous improvement. Martin's strategy is designed to manage the emotions like fear and greed, as emotions can significantly impact trading decisions and lead to impulsive actions and cloud judgment. Martin's strategy has been back-tested with historical data of various trading assets and has been assessed with strategies' viability and potential profitability. Further continuous learning, adapting to market dynamics, and maintaining discipline are key to successful trading.
We'll be introducing you to an incredible trading strategy named the Martin strategy, which can be used to trade any instruments available on TradingView, be it stocks, Forex, crypto, commodities. The strategy interprets market data, identify trends, and generate trading signals, and it is a directional trend catcher which gives us a sweet spot to enter the trade with confirmations and deliver huge profits with precise entries. We have also introduced one new indicators to filter out the bad signals and consolidation, namely the Martin Cloud, which also works as dynamic support and resistance and also shows us the trend of the market, which we will be looking at shortly. Martin strategy has its own unique purpose and methodology. Some indicators focus on trend identification, allowing us to determine whether the market is moving upwards, downwards, or sideways.
Other indicators provide signals for potential entry or exit points, indicating when to buy or sell an asset. Fear of missing out refers to the emotional response experienced by traders when they see others making profitable trades or participating in a rapidly moving market and fear that they are missing out on potential opportunities to make money. It is a common psychological bias that can influence trading decisions. FOMO in trading can lead to impulsive and irrational behavior. Traders may feel compelled to enter a trade hastily without conducting proper analysis or considering the risks involved. This fear-driven decision-making can result in poor trade outcomes and losses, and Martin's strategy is specifically designed to overrun the FOMO. FOMO often arises in volatile markets where prices are rapidly increasing or when there is significant news or hype surrounding a particular asset or trading opportunity. Traders may feel pressured to jump into the market to avoid missing out on potential gains, even if it goes against their trading strategy or risk management plan. To mitigate the negative effects of FOMO in trading, it is important for traders to establish a well-defined trading plan and stick to it. This includes setting clear entry and exit criteria, determining risk tolerance, and implementing proper risk management strategies. Martin's strategy concludes all the above and keeps your psychology calm and ready. Are you ready to transform your trading career and kick out FOMO while trading? Let's dive in. There are 4 core indicators used for Martin strategy: Martin Trend Meter, Martin Stochastic Trend, Martin Cloud, and a range indicator. First, let's see about Martin Trend Meter. Martin Trend Meter is coded to gauge the asset's trend and depicts us to go long or short. Rules are simple: 3 green rows is a long signal, and 3 red rows is a short signal. We combine the strength of the trend meter with other indicators of the strategy to filter out the good signals and make profits. Let's see about Martin Stochastic Trend. Martin Stochastic Trend is coded to gauge the momentum of the asset and presents us a long or short signal. A green stochastic trend combined with 3 green trend meter is valid long signal, and vice versa for short signal. Whenever you take a long or short, these 2 indicators should be green for long and red for short. Now let's see about Martin Cloud. Martin Cloud is coded to gauge the asset's volatility and acts as a filter for the trend meter and stochastic trend signals. Clouds also represents dynamic support and resistance. The blue line represents support and red line represents resistance. Rules are simple. First, do not trade any signals when the price is in between the 2 clouds. No longs when price is below the red cloud, and no shorts when price is above the blue cloud. The blue and red lines in the Martin Cloud can also be used as trailing stop loss, as they are improvised version of average true range. Now let's see about the range indicator and how do we use it to our advantage. We use the range indicator precisely for entries and stop losses, and also we use it to find a valid signal candle to trade. We use the price action of previous 3 candles high and low and marks as a range, and we use it to our advantage in the strategy. We are seeing the example of 5 minutes time frame, and the range indicates the high, low, and equilibrium of the previous 3 candle. Now we will see the rule. No trades to be taken when the price is within the range. We always need a first breakout and close above the range to take the trade. Let's see an example. We always need a breakout to enter a trade, always, as we are chasing momentum. These are the indicators that make up the Martin strategy successful. Now let's see how to execute a signal. I am showing you an intraday setup on US 100 index on 5 minutes time frame. We are the start of the day, and we will fast forward and validate at how we execute a signal. And now we passed on mini candle. We will mark the day high as the breakout point. We will not initiate any long below the day high. We had a sell signal on the indicators, but it's not a valid signal as we above the Martin cloud. Now we have a long signal on the indicators, which validates our rule as price is above the resistance cloud and crossing day high, and it marks a signal candle. We will execute a long after a candle closes above the high of signal candle. The price did not give a closing above the high of signal candle, which invalidates the trade, and we wait for the next breakout to appear. By this way you will eliminate the consolidation and be only on the trending momentum. Now again we got a signal candle with long, which fulfills all our criteria for a valid trade setup, and we wait for the candle close above the signal candle. Again, that was fake breakout, and our rules of the strategy saved us. Now we wait for a valid setup. Now once again we have a valid long signal, and we will take a long trade once price crosses above the signal candle high, keeping the stop loss below the previous 15 minutes candle low, and targeting one is 2 risk reward ratio, and the trade will precisely hit the targets as we enter the trades on valid conditions of the Martin strategy. Okay, let's see how this strategy works on Forex, and how do we validate the setups. We are watching at Euro USD chart on 15 minutes time frame, and we are the start of the day. Rule number 1, no trading before the establishment of first range on the range indicator, as we need a range of 45 minutes in case of 15 minutes time frame to develop. Price is above the Martin cloud, so the trend is bullish. We will take setups only when we have a valid signal candle and take on trade candle. We have a valid long signal here. We will wait for the price to close above signal candle high to mark it as a trade candle. And now the price is closed above the signal candle high. We will place a stop limit long above the high of the trade candle with stop loss below the range low with 1 is to 2 risk reward. And we wait for the setup to complete. This is how the Martin strategy is designed to catch only trending momentum burst moves with precise entries and exits without any FOMO. Okay, now let's see how this strategy works on Indian index, Bank Nifty. We are watching at Bank Nifty index chart on 5 minutes time frame. Wait for first range to form to take any trade decision. As the rule, no trades when price is in between the Martin clouds. Martin strategy helps us to keep calm and stops us from taking irrational, undecided trades in middle of nowhere. And now you will get to know where and when to enter a trade and exit, which is the core part of any money-making methodology. Now we have a signal candle which fulfills all our rules, and we will mark it as a signal candle, and we will wait for the trade candle, which is the candle close below the low of signal candle. And we will place a stop limit long below the trade candle low and stop loss above the range high, and targeting one is to 2 risk reward. You don't need to see the price movements. Also, when you follow the rules properly, you will get plenty of setups every day on 5 and 15 minutes time frame in any trading pair. Now let's see how the strategy works on gold. We are watching gold on 5 minutes time frame. As the rule, no trades when price is in between the Martin cloud. We will move forwards to see any valuable trade opportunity arises. We always need a strong candle, bullish or bearish, for it to be a signal candle. Now we have short signal candle and will wait for trade candle to enter. The signal candle was invalidated as the price did not close below signal candle. After a tons of backtests and watching more than 1,000 successful breakouts, we have designed the trade placement of the Martin strategy to find signal candle, trade candle, and trade placement with proper risk management to keep you in the game always. Now we have a short signal candle appearing again. Let's wait for trade candle to enter. We need a close below signal candle low. Now the second candle closed just below the signal candle low, which marks it as a trade candle. We will now place a short limit sell below the low of trade candle, and we place the trade placement as per the rules, and the targets will precisely hit. Now quickly let's see one more example on gold. No trades when price is in between Martin Cloud. Just see how well the Martin Cloud top is working as dynamic strong resistance and also depicts the volatility in the price. Now we have a valid long signal candle followed by a strong trade candle, and go as per rule, placing stop limit long above the high of the trade candle and placing the trade as per rule. That was quite a few examples of the strategy, and I am sure you would have loved it. Thank you for watching. We will conclude the video, and make sure you subscribe and follow us to see more videos about the strategy. We will be posting backtest videos on various assets shortly. If you want to learn more and want the indicators, you can contact us on Telegram, which is mentioned in the description of the video.